Hey guys, this video we're going to be covering corporate finance. To be specific, we're going to be covering how to look at projects, NPV, IRR, paybacks, discounted paybacks, as well as the profitability index. Here goes. I hope that you guys have seen our previous video on time value of money. It has some key and crucial concepts for you to understand when we're calculating the NPV. Any which ways, if you do not know, don't worry about it. We have a small revision slide for you. We'll get there. Opportunities in this world are going to come to you as a project. People will ask you to invest in their ideas, in their projects. Every idea, every project needs capital and a good risk appetite. The way it works is you put in some money today, you wait for the project to run, execute, and then generate some returns. These returns occur in the form of cash flows. For all of you who do not have an accounting background, the profit after tax that you see in an income statement or a profit and loss statement is not the accounting income or the cash flow that you will consider to gauge a project. You will consider the actual post-tax cash flows. Don't worry about why the two numbers are different. We'll be covering that in a different video in financial reporting analysis. But for the purposes of NPV, you need to know that we only consider post-tax actual cash flows. Some pointers for you. Sunk costs are costs that you put in research and development. For example, if I want to bring Playboy to India, I want to assess how receptive is our society. Whether or not the society is receptive, I am going to be spending this. Whether or not I bring Playboy to India, I am going to incur this cost, so I do not consider this. There's something called externalities. Externalities may be positive or negative. When they're negative, they're called cannibalism. Let's say I make a new Batman movie with Christopher Nolan. I know if I make that in India, you guys are going to buy everything from his t-shirts to his mugs. So besides the ticket sales in cinema, I am also going to consider the sales I make in fooling the public with all these merchandises. That's externalities. That's a positive externality. Another thing you need to know is opportunity cost. If I put up a factory, I own the land. I would not consider the cost of the land, which is wrong. If I did not put up the factory, I could have sold the land or put it up for rent. I am missing out on that opportunity. This opportunity cost is reduced from the post-tax cash flows. Don't worry about the terms about NPV, IRR, payback, discounted payback. We will understand this with some humor, as usual. Statutory warning, cigarettes are dangerous. There are better things you can smoke in this world, but this is a legal video, so we will not get into that. Let's move on. Small revision for all of you who've missed out on time value of money. What is the present value of a cash flow of USD 100 million 5 years from today if money depreciates at 7%? Well, that's the timeline. I have 100 million coming in after 5 years. 7% is the discounting rate or the depreciation rate or inflation or cost of capital or required return. Throughout this presentation, I'm going to be using these terms interchangeably. Feel free to rewind and go through these terms again. I'm not repeating them. The way we discounted, 100 million divided by 7%, which is the depreciation rate or the inflation rate or the required return or the cost of capital. Why is it raised to the power 5? Because I want to know its value today or the present value. We go back by 1, 2, 3, 4, and 5 periods. That is why the power 5. The answer is 71.3 million. Let's take it up a notch. What is the net present value of two cash flows of American dollars 100 million 5 years from today and $20 million 2 years from today? Again, money depreciates at 7%. So again, we have 100 million coming in at the end of 5 years. Similarly, I'm going to take it back 5 years down, discount it at 7%, get the same number. I have an additional 20 million 2 years from down. I also want to find its value today, the present value. I discount this at 7% and raise it to the power 2 because it is only coming back by 1 and 2 periods. This answer gives me 17.47 million. The net present value that this question demands us to answer is calculated as follows. The sum of 71.3 plus 17.47, which is American dollars of 88.77. Alright, let's move on. Meet the Ambani brothers. They're a very well-known family in the city of Mumbai and the country of India as well. The guy on the left is Mukesh Ambani. He's an oil and gas major, has a degree in chemical engineering, and also has been to Stanford. Meet the guy on the right, his younger brother Anil Ambani. He inherited his dad's fortune and he runs marathons. Pretty cool guy. Mukesh Ambani has a new project for you. It's called Gamble AM1. Mukesh Ambani says he needs 100 million rupees. Today, that's your initial outlay. At the end of year 1, he promises that he's going to be giving you 60 million. At the end of year 2, 30 million. At the end of year 3, 20 million. And at the end of year 4, 10 million. His brother has another idea. He says you give him 100 million. At the end of year 1, he's going to return 10 million. At the end of year 2, 20. At the end of year 3, 30 million. And at the end of year 4, 60 million. Please note that the numbers are exactly the same, but the order has been reversed. Let's move on. Here are some real life problems. This is a family issue. You can only invest with one brother. If you pay one, the other won't accept it, vice versa. The projects are mutually exclusive. When you consider two projects, if you can invest in only one and not the other, these projects are called mutually exclusive. In such cases, you always select the project that has a higher positive NPV. A higher NPV is an indication of how you maximize your wealth. A negative NPV usually means you're going to make a loss. How? We will look into it later. Another problem, the money you invest, you need to borrow at 10% per annum. This 10% is your discounting rate or your cost of capital or the required return, the minimum required return. If the project returns less than 10%, obviously you make a loss. If it returns more than 10%, you make some good money. Now, the cash flows. Like I told you in the previous slide, the cash flows are exactly the same, but they're in the reverse order. Does it matter? Yes, of course. If you refer our video on time value of money, we've spoken about how 1 rupee today is not the same as 1 rupee tomorrow, which is not the same as 1 rupee 1 year hence. Money has time value. How does it affect NPV? Let's check it out. Here's Gamble AM1. I've put in the same numbers in the table. You put in 100 million, the negative sign implies that it's an investment, it's an outlay of cash. At the end of year 1, you have 60. At the end of year 2, you have 30. 20 at the end of year 3. 10 at the end of year 4. Now, if I add this, it comes to 120. Now, it seems profitable, but is it? Let's check out. The present value of 60 million 1 year from today is calculated using this formula. 60 is considered as the principal. 10% is your required return or your cost of capital. The power 1 since it's just 1 year. Again, please refer to our video of time value of money if you do not understand this. I discount each and every cash flow at the right time to find its present value. I find the present value and I subtract the outlay. That gives me the NPV. Don't worry, we'll take a look at this again. You add all the present value of the inflows, you subtract the present value of the outflows. Whatever you get is the NPV. It's that simple. I want you to look at the next project and try to do this by yourself. Gamble AM2. There you go. The numbers are again the same. The outlay is of 100 million. At the end of year 1, I have 10 million as an input, as an inflow. At the end of year 2, I have 20 million as an inflow. 30, 60. Again, the number 120 is the same over here. But this time, as you're going to see, it's going to be a loss. How? Let's see. 10 million discounted at 10% for 1 year gives me 9.09. The calculations are exactly the same. The formula is exactly the same. Now, when I add all of these up, this gives me the present value of all the inflows, since these are inflows. I subtract 100 from this figure because it is the present value of the outflow. This here is times 0. When I add the present value of the inflows and subtract 100 from it, I get a loss of minus 10.86 million. Therefore, you see, even though the numbers are the same, just because of the timing of the cash flows and you've borrowed money at 10%, Gamble AM2 will actually be a loss for you. Gamble AM1 is going to be a profit. I hope it's simple. I hope you get it. Alright, let's have a look at this again. NPV is nothing but value returned less value invested. What is my value returned? It's simply the sum of 54.54, 24.79, 15.03, and 06.83. All the value returned. I am not taking 60, 30, 20, and 10 because that is the investment returned. I want to know the true value, the present value, which are these numbers. When I add these numbers, I get the value returned. The value invested is, of course, 100 mil. NPV is nothing but the sum of this less the outlay. That's what this formula says. It's a nice way of looking at things. Another way someone would try to confuse you is ask you the profitability index, or PI. Profitability index is nothing but the ratio of the value returned to the value invested. Simple. How profitable is your business depends on how much you return over and what you invest. Let's take a small example and calculate profitability index. Value returned, like I said, is the sum of these four numbers. Value invested is nothing but the initial 100 that you've put in, which comes up to 1.012. If your profitability index is above 1, which means the value returned is higher than the value invested, only then and only then is your project profitable. Otherwise, it's a loss-making venture. There you go. You're done. Let's move on. IRR. Sometimes people are not going to be giving you cash flows or present values. They're simply going to be telling you the IRR. You have only two bits of information. The IRR, which is the internal rate of return of the project, and the cost of capital, or the required return. Technically speaking, in finance, the definition of IRR is that discounting rate at which the NPV of a project is zero. If you get math, I'm happy for you. But if you're like me, you like English better, you just like logic better, this one is for you. The internal rate of return is nothing but the rate of return that your project generates. The required return is the cost at which you've borrowed the money. Common sense will tell you when the return of the project is lesser than the required return, do not invest. Unless, of course, you like making a loss. Mathematically speaking, NPV is the cash outlay at time 0, the present value of cash flow 1, plus the present value of cash flow 2, so on and so forth. The denominator is such that the IRR is such that the NPV comes out to be 0. Think about it. If the denominator increases, that is, this is the place where we put cost of capital or the required return. At IRR, NPV is 0. If I increase the denominator, the NPV would fall below 0, which means that's loss, negative NPV. That's simple. When the IRR is greater than the required return, you can go ahead and invest. What happens when I'm considering two projects instead of one? Two mutually exclusive projects. I can only invest in one. What happens? Let me check. I have project alpha. Now it's simple. As the denominator or the cost of capital increases, the NPV decreases. At one point, the cost of capital is so high that the NPV becomes 0. That's IRR for you. So I have project alpha, whose IRR lies somewhere over here. I also have project delta. Project delta's IRR lies somewhere over here. The only one thing that you've learned in school is when you see two lines on a graph, there is something special at the point of intersection. In this case, this point of intersection is called the crossover rate. The crossover rate is a little special. I'll tell you why. In the region to the left of the crossover rate, I see that project alpha for the same cost of capital has NPV of value A. For the same cost of capital, project delta has an NPV of value D. Before the crossover rate, to the left of the crossover rate, project alpha will always have a higher NPV than project delta. Well, that's simple. As long as your cost of capital is less than the crossover rate, select project alpha. When your cost of capital is more than the crossover rate, you must select project delta, because that will have an higher NPV. That's the project delta NPV and project alpha. That's pretty sums it up. Let's talk about the payback periods. Whenever you invest money, there are three questions you always ask. Will I get my money back? After how long? That's your payback period. And what if I only consider the the present value of the cash flows. Since now I know how to calculate present values, I'm not considered about the value 1 year. Hence, I am only considered with the present value. If you consider the payback considering present values, it becomes a discounted payback period. This is always higher than the normal payback period. Let's take a really simple example to figure this one out. Meet one of our politicians in India. He has invested the fortune he made from your votes in a project called ROI 69. Suddenly SEBI, for all of those of you who are watching this video from the United States, SEBI is the Indian equivalent for SEC that you have in America. So SEBI has decided to audit this project. Our so-called leader thinks he may not see the profits because the audit might actually stop the operations, but he wishes to know how long will it take to have his initial investment back. I use the word investment, you say payback period. He also wants to know how long will it take to have the initial investment's original value back. When I say value, you know you're dealing with present values, time when you calculate the discounted payback. His cost of capital or discounting rate is 10%. I don't really want to help this guy, but I really want to help you learn. So let's move on. For ROI 69, the initial outlay that he put down was about 2,000 crores. The minus sign indicates that it's a cash outflow, it's an investment made. At the end of year 1, he made 1,000 crores, 800 crores at the end of year 2, 600 at the end of year 3, and 200 at the end of year 4. Now I'm just going to find a cumulative balance. At time 0, today, it's 2,000. I'm finding the payback period in this slide. After 1 year, out of the 2,000 that he invested, 1,000 was recovered, which came from here. That means I still have 1,000 pending. At the end of year 2, from the 1,000 pending, 800 more was recovered. So I just have about 200 pending. At the end of year 3, I recovered 600 more. When I add this, I have already recovered my initial investment, plus I've started to see a profit. So a payback period is something like, I don't care when I see my profits. I actually want to know when will I get my original investment back. Whatever comes on later is the profit. So now let's see how we calculate this. Between year 2 and 3, the value went from negative to positive. It went from minus 200 to 0 and from 0 to 400. I want to know how long did it take to go from minus 200 to 0. I don't care about the profits, I only want to know how long does it take to achieve payback. When it reaches value 0, we say that payback has been achieved. So it's taken 1 year, 2 years, and some more time. Now how do I calculate this some more time? It's pretty simple. Minus 200 goes to 400. The jump length is 600 crores. So in 1 year, I cover 600 crores. How much time will it take just to cover 200 crores to reach 0? It's pretty simple. The formula is 200 by 600, that's 0.33 years. Thus the total payback time is 1 year, 2 years, and 0.33 years more, 2.33 years. It's pretty simple. Let's move on. The discounted payback. I'm going to find out how long is it going to take our politician to recover the value of his investment and not just his investment. The numbers are exactly the same. And what I've done over here is I've just found the present values. 2,000 remains the same. It's an outlay. It's an outflow of cash since it's the investment at time 0. At the end of year 1, I have 1,000. The cost of borrowing is 10%. I discount it by 1 year, by one period, which gives me 910. Similarly, I find the present value of each and every cash flow over here. The present value of 800 is 661. That of 600 at 10% is 451. Now, I do the same thing over and over again. Minus 2,000 is what I lost today. After 1 year, I have effectively only recovered a value of 910 out of the 2,000 that I invested, which gives me a balance of negative 1090 or minus 1090. At the end of year 2, 661 crores are recovered further, which gives me negative 429. That means I still have to recover 429 crores. At the end of year 3, the value I recover is 451 crores. When I add that to the pending balance, I get a positive number. That means again, between the year 2 and 3, I have reached from minus 429 to 0 and from 0 to 22. Again, I only wish to find out how much time has it taken to go from minus 429 to 0 in this year. So it's taken me 1 year, 2 years, and some more time. How do we calculate it? The same way. In the year, it went from minus 429 to 0 and 0 to 22. That means the total jump is 451. I just add the two numbers. So if it takes 1 year to grow by 451 crores, how much time would it take to only grow by 429 crores and reach 0? Answer is simple. Just divide the two. Unitary method. I'm not going to teach you the math. The answer is 0.95 years. Thus, the total discounted period is the 2 years initially that I portrayed, plus another 0.5 years to go from minus 429 to 0, which is 2.95 years. Well, that's pretty much it on analyzing projects. I hope you enjoyed our video. Please write to us or visit our website and get in touch with us if there's something that you didn't understand or something that you'd like to understand. We'd love to cover more topics. Watch this space for more. Soon to come. Thanks.